Now, the focus turns to the ultimate objective by asking a question. Asking how does this reform and policies help us to just not protect our economy in the shocks, but also will help us fundamentally in lifting the growth and building a lasting resilience. For that, please join me in welcoming our panelists for this panel. Please welcome Her Excellency, the Managing Director of the IMF, Dr. Kristalina Georgieva. His Excellency, the Minister of Finance of the State of Qatar, Mr. Ali bin Ahmed Al-Kuwari. His Excellency, the Minister of Finance of Turkey, Mr. Mehmet Şimşek. And Her Excellency, the Minister of Economy and Finance of Ecuador, Ms. Sariha Moya. This session will be moderated by Ms. Gillian Tett. She's a columnist and member of the editorial board of the Financial Times. Please help me in welcoming our panelists and moderator.
Thank you. Well, thank you very much indeed for that warm welcome. Hello, everybody. Assalamu alaikum. And I'm delighted to be here. As you've heard, I am both a columnist with the Financial Times. I also oversee King's College in Cambridge. Now, I was recently at Davos, along with the managing director and many of the other people in the room. And of course, at Davos, one of the biggest debating points was what Mark Carney, the leader of Canada, called the issue of the rupture. The idea that there is now a major reconfiguration going on in global trading and political arrangements, which is causing enormous shock for the Europeans and Canadians and others. And the leader of one of the emerging markets countries listened to his speech and then said to me afterwards, "You in Europe might think this is a rupture. We don't quite see it that way. Because here in the emerging markets, we have never quite believed all of the language around global cooperation. And we've been dealing with political shocks almost continually for a long time. So the idea of a rupture is really the view of the privileged West. From the global South perspective, it looks quite different." And I was thinking about that when I was looking back through the International Monetary Fund's report that was issued last October for the annual meetings, which points out that throughout these bumpy, ruptured-laden times for the emerging markets, one of the key points that's very striking that we've heard a lot about in the last 2 days is that although the emerging markets face challenges, they have actually been a lot more resilient than many people might have expected, or that they've been in the past. And as the chapter in the IMF report says very astutely, it's important to try and work out whether that's because the emerging markets have been lucky or been wise. In the financial trading floors of Wall Street in the City of London, the tag often goes, "It's better to be lucky than wise," because luck is often more important. But the question really is, have the emerging markets been lucky or wise in the past? Will they carry on being lucky? Will they be wise? And to go back to the theme that the MCs raised earlier, having heard the theory about what they could and should be doing yesterday, today we're talking about the practical steps about what they should do to try to be wise. So I'd like to start with you, Managing Director. I think we both got the same memo in terms of our colors today. But in your view, do you think the emerging markets are ready to be wiser than before? What are the key steps they need to take to be more resilient? And do you think they will carry on being lucky?
Great to be on a panel with this fabulous team. in this incredible place. I would say luck is always welcome, but luck works best when there is a foundation and wisdom. And what we have seen over the last decades is that many emerging market economies have taken lessons from the advanced economies on how to carry out their policies on the monetary side, on the fiscal side, in a way that gives them a better foundation to face the shocks that are now coming more and more often. I want to make two observations based on IMF policy research. The first one is that countries that have taken medium, long-term view on how they build institutions and policies have seen a significant improvement in their growth prospects and a lower level of inflation. To be more exact, emerging markets that have taken that wisdom message to heart have achieved 0.5% higher growth and 0.6% lower inflation. In other words, there is a material benefit for their economies, for their people. Message number two, we now find that emerging markets are more interested to compete with each other for who does better in this policy arena. I know that I'm speaking here to the converted. Many of the emerging market ministers are here, but I more often now hear them talking about we have done better in any field of the, any area of policy. And I love this competition. I'm very much in favor of competitive environment. And what is striking is that if 10 years ago, even 5 years ago, they would be comparing with advanced economies, now they're comparing with each other. And I find this to be indicative of the fact that emerging markets are now actually a larger part of global GDP. They have the wisdom to make best use of their luck.
Right, so wisdom pays. You can see that in the financial markets and the behavior of credit spreads. And frankly, there's a lot that advanced economies can sometimes learn from emerging markets right now as well. But I'd like to turn to you, Minister Shimshek, and say, of course, the reason why Mark Carney spoke about rupture was partly because of this dramatic explosion in protectionism and trade wars. Now, for a country like Turkey, like many other emerging markets, you are sort of caught in the middle between trying to both be friendly to America and Europe, but also maintain good relations with China and your Middle Eastern neighbors. How do you see the challenge of navigating this trade rupture or reconfiguration, or as we heard yesterday in that fantastic paper, redirection of trade? How is that playing out for you?
Well, Mark's, obviously reference to rupture is appropriate because last year we've seen probably the VUCA moment for global economy in terms of volatility, uncertainty, complexity, and ambiguity. So it's been tough out there. It's been a difficult year with heightened uncertainty in particular, which for emerging markets, it could be more challenging, even though not all emerging markets are created equal. Well, first of all, I think emerging markets typically they rely on exports, and that's clearly an issue. So there's more vulnerability there, generally speaking. Emerging markets also rely on external capital inflows, including, of course, FDI. In a rule-based environment, you tend to enjoy, I mean, I'm talking about smaller players, mid-sized players, you tend to enjoy, relative to today, a lower risk premium, lower cost of doing business, and FDI tends to be anchored in a more rule-based system. And FDI is the best channel to access new technologies, know-how, to enhance productivity. Now, how does Turkey deal with this? Well, we're a bit lucky and a bit wise. Luck comes from the fact that we have a customs union with the EU, that's 27 EU members, and we have 27 other free trade agreements with other countries. So roughly about 62% of our exports are covered by FTAs. Now that doesn't give you a full peace of mind because things may change, but at least for now, as long as our partner stays rule-based, FTA provides you with some insulation, I mean, relatively speaking. So we're not immune, we're not, but certainly we're less vulnerable. The rest of our trade is concentrated in our immediate neighborhood. I'm talking about Middle East, North Africa, Central Asia. So if you take that parts of the world also into account where nearshoring or friendshoring comes in, or friendly countries, it accounts for over 80% of our exports. So that's one point I want to make. Secondly,
so you have a rules-based framework for much of your trade in place still.
Exactly. And secondly, if you look at our trade of services, we are among the top 20 globally. When it comes to tourism, we have number 4 spot. In construction, we're a major player. Even in soap opera exports, we apparently among the top. So services is where our strength is. And we have been focusing on that. Services export has not yet faced the type of protectionist measures that goods have faced. So that gives us an advantage. And that's where really much of our focus is right now. There's where more value added is, where job creation is. So clearly, we're not immune, but we happen to find ourselves in a relatively less vulnerable. But of course, in the meantime, over the past 2.5 years, we've been implementing a macroeconomic stabilization and reform program. And that program has helped in terms of investing in buffers, building resilience, because it hasn't been easy. We don't live in a great zip code, as some would say.
Yeah.
It's a rough neighborhood with all sorts of conflicts and tensions. So we're doing fine. Growth has been resilient, and trade has been resilient, and we're addressing imbalances. We are introducing structural remedies to help make all these sustainable.
Right. Thank you. Just before I turn to Minister Moya, one other quick question linked to that is, we heard yesterday about the diversion of Chinese exports into many markets. How does that affect Turkey at the moment? Are you competing with those Chinese exports? Is that lowering the cost of your production and making the battle against inflation easier?
It's one of the biggest risks to our external imbalance. But how to deal with it and what does it mean for disinflation, those are separate issues. Diversion is real. Our trade gap vis-a-vis China is now close to $47 billion.
Yeah.
That's quite large. It's more than 50% of our global trade imbalance. We have a large services surplus and trade deficit. So we see very strong evidence of that. I don't think a country the size of Turkey alone can deal with this. So what we've been trying to do is to talk to our Chinese friends to say, look, let's see how we can fix this together. Instead of one-way traffic, one-way street, how can we make it mutually
Right.
sustainable? So I suggested to our Chinese counterparts that they should allow more Chinese tourists to visit to Turkey. And they said, well, they don't get in the way. I said, well, you need to give us more slots, more flights. So they cannot walk from China to Turkey. So that's number one. Number two, when you have large surpluses, you need to recycle them.
Yes.
And no point of keeping it in gold. Recycling is a better avenue. And what my suggestion was is that you have very large footprint of your banks like ICBC, Bank of China. Why don't you let them recycle some of that surplus in Turkey for long-term infrastructure projects or other industrial policy initiatives? And thirdly, finally, I said maybe, again, you should allow your companies to tap Turkish markets, not by just selling goods, but also through manufacturing. Because Turkey, you're talking about almost, including Syrian refugees, you're talking about 90 million people.
Absolutely.
With a per capita GDP of $18,000, $1.6 trillion market. This is a sizable market. But there's been very limited progress across the board. We're optimistic.
Well, maybe that this will help today, saying all this. I know that the managing director wants to come in at this point, and I'll turn to Minister Moya.
I want to make a point that in China there is a growing recognition that the economy is now too big to be an export-led growth economy. And that translates into a commitment to swing more towards domestic consumption. And I believe that an engagement within emerging markets, as we just heard from the minister, to do a fairer trade is very important, because if this doesn't happen, ironically, it could be China, not the United States, that destroys the rule-based trade system. Why? Because if there is no change, then countries are left with no option but to put tariffs on Chinese goods. And then the proclaimed integrity of the world economy may be undermined by a country that now is standing as a defender. So to everybody in the audience, in the emerging market family, work towards achieving exactly that, get imbalances to be a subject of common interest, to be resolved as a common interest issue.
Right, well, since today's focus is all about practical next steps, maybe that can indeed be a practical next step, and maybe Turkey can be the pilot case for that. But of course, Ecuador is also dealing with its own challenges. Now, you have just signed, Minister Moya, in 2024, you managed to sign trade deals with both China and Costa Rica. So that's one set of rules-based deals. You've also just a couple of months ago signed a trade deal with America as well. So congratulations on every front. But of course the question is, how on earth do you manage to balance those two big interests out? And are you assuming that the future is primarily about bilateral trade deals if you want to have a rules-based order, as opposed to multilateral trade deals? Because we just heard from Minister Shimshek that the decline in the rules-based system is likely to hurt many countries like Turkey or like Ecuador. So how do you frame the current situation?
Thank you so much for this space where we can share the experiences that we had. In Ecuador, we are implementing a trade policy that seeks to diversify the partners that we have, while we are also diversifying our industries and the products that we are exporting. Ecuador has been working on identifying the different vulnerabilities that we can have when we are trying to pursue growth. And one was that when you thought on Ecuador, you will think on oil and dependence on oil from exports. So we have to strengthen the non-oil industry. In 2023, with the numbers from January to November, the non-oil trade balance was less than 400 million. Right now, our non-oil trade balance, it's 4.9 billion positive. So that gives you the results of boosting our non-oil economy with the purpose of exporting more, exporting better, and exporting to more countries. We also just closed the negotiations of a commercial agreement with the UAE. Just right now in Dubai, we'll sign an agreement this year, and that's part of this policy that seeks resilience in time. Ecuador is a small country, so our producers have understood that we need to produce quality products. When you produce quality products, the best shrimp, the best chocolate, the best bananas, then you are less sensitive to tariffs. You are less sensitive to changes in prices. We have, our partners are very diverse. We export to China, to Russia, to the US, to other countries in the region. And despite the uncertainty on the geopolitical times that we are living, we were able to increase our non-oil exports in 20% during this year. And this is because our producers have put their efforts on investing. Our producers are finding more financing in better conditions. We've implemented a strategy with the central bank in order to have a flexibilized interest rate system for the productive credit. Unfortunately, in Ecuador, we don't have a liberalized interest rate system. That's actually something that we are working as a structural benchmark. We have ceilings. Doing this has helped us to allocate better the resources. Our financial system has increased deposits in 40% in the last 2 years. So they have liquidity. Now, how that liquidity goes to investment, goes to production, not to consumption only.
Right.
So we worked on this strategy, and we've seen that credit has increased in 12%, but the productive credit has increased in 19%. The agricultural sector is importing 30% more capital goods in this year than in the former years. So you see a virtuous cycle that comes with the policy, the partners that we have with the World Bank and with the IDB. They have agencies that are financing our productive sector, and then you see the results. You have to work with several actions in order to achieve this. Right now, we are exporting more shrimp than oil, 1 billion above.
Wow.
That was unthinkable in Ecuador in the past years. But then, how can we sustain this in time? It is linked to an economic policy that has been pondered over and over in order to get these structural measures that start in the fiscal side. In Ecuador, we don't have our own currency. We are a dollarized economy.
Yes.
We only have fiscal policy. So that the efforts have to be there. And it doesn't mean that we won't face challenges or that we won't have a production problem with the oil industry, for example, that happened in 2025, or that we have to be able to find those vulnerabilities in order to transform them in a strength.
Right. Well, that's fascinating, and that echoes a theme, of course, that the MD has highlighted, and we heard about this morning. But I'd like to turn now to Minister Al-Kuari and ask you, Qatar is in a slightly different position because you obviously do have an oil bonanza and gas bonanza for many years, but you have very deliberately been trying to reduce your vulnerability to external shocks by trying to put your fiscal position in a better position and to pay down debt. Tell us how you see what the policy priorities should be for the resource-rich EMEs, emerging market economies, at the moment. Because one of the fascinating details of the paper yesterday was that actually commodity EMEs have not actually done that much better than non-commodity-based EMEs when it comes to some of their policy choices.
Thank you very much. I mean, I'm so happy to be here today, and thanks to our host for inviting us. I think I will go back to your first statement, when you mentioned about emerging markets. Is it discipline or is it luck, And I will say it's discipline more than luck, because I think, emerging markets, countries have been really, working or by the book, to make sure like they follow exactly what's been needed and they're following the rules. So emerging markets countries, whether they are oil rich or non-oil rich, I think they were really trying very hard really to fix, the fiscal position and make sure like they go by the book where they, so it's really purely discipline in their side. And this is no different than Qatar, in Qatar, although yes, the fiscal space is quite good and we have, good years of surpluses, in the country. But we always look at fiscal sustainability as an important issue, and we have to have a view in the fiscal medium-term views, and even longer. So what we have done, we have developed a fiscal policy framework, which is a medium-term fiscal policy framework, which have a 20 years view in the fiscal position of the country under different scenarios. So what do you call it, optimistic scenarios, conservative scenarios, especially in the revenue side, and at the same time how our spending should behave, and taking into consideration, because we need to have a holistic view. We should not just look at it like spend this much and have revenue this much, and we should look at it like what's the debt position should be, how does it look like, investment in the economy, because we have to continue to invest in the economy. It's very critical. It's not like just, we're not a consuming economy, just, spending for the sake of spending. So we have to continue to invest to meet our long-term vision, our diversification, human capital development, technology. So these, projects has to be also very well spent of. Intergeneration equity, is extremely important. So continuing to invest on the Qatar Investment Authority, which is our tool for intergeneration equity. So with that view, and then also we look to the other things like, how the central bank's reserve should look like, shall we keep like, a fund for, for a stability shock fund, like under the control of Ministry of Finance, so we don't have to go to the debt market.